Now that we're in the post-tax reform situation here in the United States, I wanted to update on a couple of items that came out of the tax reform bill dealing with real estate. Now, the biggest one that I talked about previously was the fact that we would be lowering the mortgage interest deduction. Now, that did happen in the tax reform bill. It was lowered from $1 million down to $750,000. Originally, there was a question as to whether or not it may be eliminated or even limited down to $500,000. Now, a couple of the specifics on that $750,000 is it is all of your mortgage debt. So it's first mortgage, second mortgage, or any second home mortgage. So you're limited to the interest on $750,000 worth of debt. And they did eliminate the home equity line interest deduction. So two changes. Went down from $1 million to $750,000 and eliminated the $100,000 equity line deduction. Now, a couple of other things. The biggest one that has come out in the national media has been SALT, state and local taxes. And there's now a limitation on your deductibility of those state and local taxes. You're limited to $10,000 a year. Now, in South Carolina and in York County and Columbia, in Richland and Lexington County, there are very few houses that actually pay more than $10,000 a year in state and local taxes, but they do exist. So for the everyday taxpayer, it's not going to be a big impact on you in our area. However, if you own a property at the beach, you own a high value property on either Lake Wylie, Lake Murray, Lake Norman, any of those areas, then you're going to have to look at what may be deductible for you in determining the tax consequences of buying that house. Now, there are a couple of other ones when you look at it. You know, obviously we got a double standard deduction, but if, of course, you own a house, a lot of people don't use the standard deduction or didn't before. Now they may be in that standard deduction area, and with just the deductibility of your interest, state and local taxes, and charitable, you may not reach that $24,000 a year for a married couple. If you are above that, you'll still itemize, and you have the opportunity to then take advantage of higher mortgage interest deduction or additional expenses that you may have in filing your taxes. So all in all, not a bad tax reform for real estate. There are some other provisions that they kept Section 1031 exchanges for real estate only. They eliminated the personal property ones. That's a big deal for real estate, and especially commercial real estate. For those of y'all that invest in that, it's a big part of it. Pretty much the other things that we brought up before, student loan deductibility continued. Child tax credit was doubled. All of these are good things. It will be very interesting to sit down and have this conversation in June or July once we've all gone through the tax changes, what's going to happen, and we've of course gotten past this part of the filing year. Now, a lot of people did take a lot of deductions at the end of last year and moved income into 2018 if they could legally do so. So the reason is they're getting a tax break this year. So the deductions were worth more last year. Now they're not, and we'll see how this changes for 2018. But overall, for real estate, the tax reform bill was a good deal.